Good morning, everybody. Happy Friday. We'll get started here in about 8 minutes. I hope everybody's doing good this morning. Yeah, I got out of my natural gas, watched for it as approaches, and it did break out. Had a very nice one too. Let's see. Now remember, this is that manipulation phase, so don't try to short it here. We'll just wait for a topping pattern. So. Huge. Hey, good morning. Let's cover those couple of topics when we start. Morning, Jeff. Good to see you. Let's see. The question is, let me turn off the music. Since gold and silver are dropping so much, are they entering the bear market and also on Bitcoin? Okay, yeah, I'll cover both of those as we get started. And start doing that in about 3 minutes here. Great questions. Great questions. And it does kind of go along the lines of, the comments I made in the pre-market routine that I do each day, talking about the commodities, including Bitcoin, micro Bitcoin, have similar prices or price movement. And these are commodities in general, not just Bitcoin, okay? Around contract rollover and last trade date. So very good question to ask, but we will have some ways we can go back and verify that too. So great question. All right. Just about 2 minutes, we'll get started here. All righty, let's go ahead and jump right in. Good morning, everybody. Today's January 30th, 2026, the last trading day of the month of January. A couple things to keep in mind is to go back and look where the first day of trading in January, January 2nd, where did it start out as? The Stock Traders Almanac, and for, gosh, many, many years, they have a topic called a January effect. Okay. So if the market closes higher than where it closed on the first day of trading, often it is typically an up year. Okay. That doesn't mean we won't have some swings going around. Okay. But we tend to end the year on a high note. Okay. Um, okay. Thank you. So today's going to be a little tricky. Okay. Because we're actually right near that January open or that trade day. So let's bring that out here. So I think January 1st, because yesterday we went down and tested that area. So let's put a vertical line on the first trading day of January. So January 2nd, and it closed about 69.01. Okay, so we need to close above the 69.01 today in order to according to the Stock Traders Almanac, have an up year. Okay. Yeah, my charts are getting a little funky already. There we go. So yeah, we came right down to that 50-day moving average, which is right where we got that sizable bounce. Okay. Now, a couple of things on the equity indexes. We have to go out to a little larger time frame here. Oh, we have to go out to the, there we go, exchange traded funds. Is that, the Dow needs to have a sizable up day, and we're looking for IWM. We're already seeing that the Qs are gapping down. You notice how it came into a fair value gap on a 30-minute chart, same with the SPY, and they're gapping out of that, okay, to the downside. Now, I do expect, based off of the equity indexes and what we're looking at and how we're starting out, is that we may go a little bit lower before we go higher, okay? So looking at the Dow 30 stocks, look at how light the volume is. So we're going to, at the open, as we've seen most of this week, it's just a whip up and a whip down and a whip up and a whip down, okay? Now, as we're starting off today, we can prepare for that. Okay, we notice the volume on the Dow 30 stocks is very light. Okay, well that helps us anticipate that the open's going to be whipsaw back and forth. The price going to drop, find buyers. Price going to rally and find sellers as the banks and institutions start putting together their day. Okay, they're just filling orders. Okay, and if there's a low volume, a lack of orders, then price will drop to find the buyers, rally to find the sellers. The algorithms just kick in and to process orders. That's all it is. Okay. It's not about news or economics and all those things can play a factor in things. Um, we're just looking at that whipsaw price action. Okay. So as we do start off with the light volume and what I was just talking about there, notice that the S&P currently trading inside the prior session's high and low, inside day. Inside days can be a little choppy, designed to take your money. That's what we always remember. And but there are some good characteristics about this. Very often, the gap fills. So price at some time during the session will come back up to the 5 p.m. close. Very high probability of that trading environment. Okay. We also notice that the Globex range, 77 points on the S&P, compare that to the daily ATR at 82 points. And when the Globex range compared to the daily ATR is greater than 70%, okay, which we're in that range, this is where the bull trap and the bear trap come into play. Okay, it's just a trading tactic that happens, and some folks refer to it as a liquidity sweep, where price breaks above the Globex high or prior sessions high, and they kind of sweep out the sellers, or just the inverse, drop below the Globex low or prior sessions low, and sweep out traders. Okay, liquidity sweep. Now, those are also very good techniques, and some traders are very good at doing that. But just getting an understanding of where we are right now, what to expect. Inside days, light trading volume, we can expect a little more whipsaw. Now, when you study this, and not just the opening, but you carry it through the rest of the day, how did the beginning, the middle, and the end of the day work with the inside day? Okay. Now, what you will start to see is that towards the London session close, that's when trading starts to get back in line. Okay. Now, I also wanted to bring this up as well. Okay. So, looking at a 5-minute chart on the equity indexes this morning. Okay. What are you noticing? Let me help you with that. Are you noticing that the patterns are similar? Okay. This is the first time all week that we've had all of the equity indexes with a similar shape and pattern. This is referring to a 5-minute chart, okay? We have experienced much of this week as, the opening being some very volatile, whipsaw, and a little more difficult trading environment. Now, when we see all the indexes having this similar shape and pattern, they're kind of now synchronizing, okay? Which makes it an easier trading environment. But on the other hand, we still have the S&P and the Nasdaq as an inside day, while the Russell and the Dow are outside. Now, all of these things that I'm mentioning trigger a different response, trigger a different price pattern in our brains. Okay, if I say head and shoulders pattern or double top, double bottom, you're thinking reversal patterns. If I say cup and handle, if I say pennant, flag, wedge, base, those are continuation patterns. Okay. At any rate, when we're going through and looking for potential trading opportunities in a session, all these patterns that we pick up on, they create the emotions, the FOMO, the fear of missing out, the greed monster, okay? And they create all these different emotions. But we have to equate those emotions to a market condition. Well, yeah, I can see it's an inside day. Globex range compared to the daily Globex range inside the prior session's high and low. Okay, well, so what? What does that mean? Okay. Well, it starts to trigger a series of events. Okay. Inside days at the start tend to be a little more whipsaw and choppy. Okay. Well, what enhances the whipsaw? Light volume. Okay. So we got light volume. We got an inside day. Characteristics, the better trades happen about 10:30, 11 o'clock Eastern after the market opens, where can I sit on my hands during that time and wait for the trades? Also, breakout trades often fail on an inside day. Okay. And they'll just break out and then they'll whip right back in. So the more we explore this, the more we understand how to position ourselves for an inside day. Then we take the time and look at each of the equity indexes, S&P, and we'll bring up the NASDAQ. We can see that it is also an inside day, and we expect similar conditions. Okay. The Dow, the Dow did break outside the prior session's range, so it doesn't have the same rules. Now, referring to the Dow, we do see that we have a very big area where price channeled sideways in here. Okay. Now, this range is what we call an accumulation. A breakout to the downside, that's the manipulation. And then we're going to be looking for a place where we can get distribution or the AMD type trade. It also correlates greatly with what Wyckoff teaches. Okay. And we're looking for, if price starts to go back into this range, we know that all the orders have been filled inside of this range. Okay. And we expect price to move through that range. Okay. So the sideways choppy markets also become an area where we could look for easier price movements. Okay. Now, putting a couple of the pieces together, looking for that easier price movement, how would you like to see? I mean, what would be a perfect scenario for you to see? price going back down, making that double bottom, then start working its way through so you have a nice up session. Okay. Identifying an area where we have a leg base, possibly a fair value gap trade entry. Okay. How would you then apply the information that you're putting together? Okay. So as we start off, I'm really leaning more towards trading the Dow this morning because of the potential profit that we could have if price drops or even if price sets up with a fair value gap. I expect price movement to get back up to the prior session's high. Okay. Now, to make all that possible, we would need to see that the diamonds are in a very similar situation. The exchange traded funds, okay, they look like they're each one of them are gapping down this morning, which is going to be looking for the buyers. Okay. Right now, the diamond's trading at 488. Okay. Gapping down. Okay. And same with IWM 250. Q's down 366. And the SPY at gapping down 237 in the pre-market. Okay. Currently trading at 691. Okay. And we can see that at 691, if price opens there, it's going to be below that range, also where we have a lot of filled orders. Okay. Now, this doesn't mean that the market's going to keep going down or keep going up. Okay. It's just what we're collecting right now is information about the trading environment. Now, we do have an upcoming class. Uh, let's see. Oh, we do have yeah. Can you give me the other for the upcoming class, the promo and promo code that we can look at? We do have an upcoming class where I explain in detail why we look at all of these pictures, what they pictures mean, how to study them, document them, verify them, so that when you start utilizing what I'm doing, and you also see the characteristics of my teaching, is that when we're in an inside day, I slow down. I don't take a lot of trades. Okay. We tend to uh, wait a little longer. We wait for the leg base or zone entries. Okay. We incorporate that with the light volume and several other pieces of information on the price chart and off the price chart. Okay. So we do have an upcoming class, pre-market routine, where I go into great detail and teach you all about the things to look for. Okay. Now, in my teaching style, when we are an inside day, I look to then compare. I'll put that up a little bit later too. Maybe we can post it in the YouTube chat. Um, we need to be prepared for the fundamental things outside the price chart as well as on the price chart. Okay. So a lot of times in the pre-market routine, we'll come through and we'll talk about what happens with commodities. Now, things with commodities is they have contract rollover each month. They have a last trade date each month. Financial products tend to expire every quarter. Okay. And when we understand the difference when we have that commodity expiring or contract rollover each month, we tend to look for those dates and what days they happen, what week they happen most often. Okay. Because most traders are not looking to take delivery of the futures product they're trading, okay, or exercising that option. So they get out around contract rollover. It gets a little messy around there. And then last trade date, we often see that prices drop as the institutional banks and stuff, they do not want to take a delivery on that either. So they'll get out much later, only to be buying in the next day after the last trade date. And you can, once you start documenting this, you start to see that each month on commodities, and some commodities are much easier to spot than others, that there's a repeatable process, a repeatable pattern that goes on each month around contract rollover and last trade date. Okay. The other thing that I want to mention, okay, is ExxonMobil and Chevron. There was a news headline that came out today reported producing oil at record rates. Okay. But we've not seen that record rate of producing oil coming into the API or the EIA reports that come out each week. Okay. Now, the fact that they're reporting this means it may be showing up this next week as supplies increasing. Okay. That means prices will be decreasing. Okay. So we can see how the dynamics of the news, but being aware of the API, American Petroleum Institute, comes out after market close on Tuesday, where the EIA report, basically saying the same thing as the API, comes out on 10:30 Eastern on Wednesday. So you can get an insight of what that report is going to be doing and then look for the opportunities in watching how the market may sell at supply and buy when there's demand. Okay. All right, let's move on here. You also notice that I do tend to teach a little bit more when equity indexes are an inside day. Why? Well, it's because nothing's really going on. Okay, look, the whole time we've been talking here for about 18 minutes, is prices just gone back and forth. Okay, not really do anything. Volume has not picked up. Economic reports, let's see, what do we have for the economic reports? 9:45, that's after market open. PPI final, we did get a little reaction. Price dropped, showed us exactly where the buyers were at for the PPI final demand. And the Chicago PMI comes out at 9:45, 1 p.m. Baker Hughes rig count, and then we have a Fed chairman, farm prices, and another Fed chairman speaking. Okay, pretty light. Okay. We also notice that one of the better trade opportunities since the Globex range at 77, comparing it to the daily ATR, is greater than 70% of that daily ATR. And that means and tells us that we should be anticipating the bull trap or the bear trap. So a bull trap is when we look for a supply zone, origin of a very strong drop, above the Globex high, kind of trapping the bulls. Okay, so we want to identify that zone up there using the leg base. You could get a little closer to the origin of that move. Let's just go ahead and do that. We have time. And as you notice, one of the things that happens when you're an inside day is after you study it for a period of time, you start to slow down. When we have an inside day, we then start to pick and choose what trading environment we like to participate in. Okay. All right, we're looking at I'm putting in the fair value gap inside of the leg base. Just to kind of pinpoint that. And we do have a wide range up here. Okay, origin of a very strong move. Okay, there may still be some leftover sell orders or even new sell orders at this point. What we do recognize is that price pattern and the strong move away showed that there were no buyers. Okay, so the sellers outweighed the buyers at this point. So price moving back up, 7,006. Okay, this is where I would plan to watch for the bull trap. Okay. We are anticipating, since it's an inside day, that gaps fill the same trading day. Okay, so we are anticipating that move up there. Now, anticipating a move and a direction is not the application of the trade. Okay, we still have to find a way to apply the trade, and that's not just buy right now and sit through all the volatility. We have to look for where we're going to have that best opportunity. And right now, with the volume being so light on the Dow 30 stocks, we should probably look at something else. Okay. Or you can drop down to a small time frame, but the inside day and the light volume include that we may be taking on a little more risk at this point. And look how choppy that market is. No fair value gaps. Yesterday, once the market started moving to the downside at the close of the London session, and then rallied back up after London session closed. Now, this is coming back to a question that Candlestick Shenanigans had over in the YouTube channel. Okay. Said, a question is silver and gold are dropping so much. Are they entering a bear market? And also on Bitcoin. Okay. Much of the reasons why markets dropped yesterday, this slide down, okay, and that also brought a nice slide on gold as well. Just plummeted, okay. There are some things going on in the capital markets from other countries that are not in alignment with what our president is doing. Okay, and so countries that oppose the U.S. Views took an aggressive stance last 2 or 3 sessions, selling U.S. Treasuries. Okay, this includes the EU trying to crash and correct our market. Okay, see, they have an upper hand in where they're holding a lot of that debt. And if you start looking about the time frame when all of this happened, when they started to aggressively sell the U.S. Treasuries, okay, we saw that our market started to drop pretty aggressively. Okay, these are tactics that are not widely talked about because they are um, basically things that are going on outside the markets that where other countries might be trying to disrupt things. Okay, and the other thing I've called attention to is how many failed bond auctions, note auctions, and bill auctions have been happening. There's been a lot of them over the last 2 weeks where we've had a failed auction. Now, the definition of a failed auction, failed bond, note, or bill auction simply means that the Fed has to step in and take the other side of the trade. See, often with the bonds, notes, and bills, treasuries, okay, we're selling them abroad to other speculators and traders, okay? But when nobody's there to take the other side of the trade, the government has to step in and take that side, okay? That means printing more money at this point, okay? And as they print more money, we know how that ripple effect comes into play. Also, keeping in mind, and anytime you hear somebody talk about repo markets or reverse repo markets, pay very close attention that the money is drying up. Okay. And as that money dries up, less opportunity for banks and institutions to borrow for the overnight, and things could get a little bit dicey. Okay. Now, all of these things are, they help us understand the trading environment and what's really going on in that trading environment. And they also help us prepare to be bullish or bearish. Okay. It's all about the flow of the monies. Okay. Crude oil starting to push up. Okay. Now, if we had record production, okay, a lot of record production, increasing oil supplies, why is oil going up? Okay. We are near the top. We have we're near a potential topping pattern. We do have a small zone, a fair value gap right back at the top, and I believe that's going to be a Fibonacci retracement area, about that 65.99. Actually, I don't want that one yet. We'll find that fair value gap area where we'll look to set up a trade. And as with many topping patterns, if we go from the high to low, making a double top, a Fibonacci retracement of the square root of 0.618, I know not to get too technical, okay, but that 88.6% retracement, okay? And we can notice that the 88.6% retracement, we can notice that the fair value gap right above the Globex high, making another opportunity. Look at the Globex range, $2.22 compared to the daily ATR. Is the Globex range greater than the daily ATR, greater than 70%? Okay. If it is, then what are we looking for as a trade opportunity? We just did it on the S&P. Okay. We're looking for the bull trap. Okay. So having a good pre-market routine, you systematically go through a lot of the information that I'm now covering, and the information leads us either to a trading strategy, especially by using the Globex range compared to the daily ATR, and saying, okay, yeah, we could look for the bull trap right here. Okay. Well, what could reinforce a price movement down? Well, more supply coming onto the market. We just had the news report record production. Okay. That's another good signal. Okay. Now, you don't have to take a large position on this. And I do want to identify where we have the leg base, leg base. You might have to adjust the time frame just a little bit. Are you looking for the start time that we're going to do the pre-market routine, Kenneth? It'll be in the evening, and it will be recorded. We got a leg base up in there. And we will be doing a live session of the pre-market routine, which will be an early start. Okay, so let's get our oil trade set up. Okay, I'm going to go for the back end of it, 66.10. Placing an order, selling short, 66.10. This on the backside, we have the 88.6. We do have fair value gap. All of that's in a zone, all in the same area. Okay. And this is where we're going to look for that short trade opportunity. Okay. Natural gas. Wow, great move on that. Nice breakout. With the understanding of how Wyckoff put things together, we can see with the chart there was a long basing pattern here. The break to the upside is implying that there's a manipulation phase going on. For me and my trading style, it's one of the more difficult places to make trades. Okay. And I'm going to be waiting for that reversal. Now, along the same lines, natural gas, crude oil, okay, energies, gasoline and heating oil also included in that. And when they produce crude oil, it also produces natural gas, heating oil, and gasoline at the same time. Okay, it's just how they separate the different types of for the crude oil. Okay, and so they're all going to be pretty much in that same camp. All right, let's get back over to equity indexes, check things out. We do have one trade set up on the uh, crude oil. I'm going to stop the video. Things started to slow down a little bit. Okay. Remember, breakout trades often fail. In a perfect world, I'd love to see price drop down right near the Globex lows. We do have a leg base, okay? Or we have the opportunity for the bull trap, okay? I'm going to set the S&P up as well for that area. Sometimes setting up the trades gets me in the right mindset that I'm waiting and not trying to trade this whipsaw right now, okay? 7,000, I'll look at 7,007 as a place to take a trade short. Okay, for the bull trap. Now, what could trigger that? Well, we only have one economic report that comes out at 9:45, okay, which could trigger that. We have a place where we're looking for a potential long opportunity between 69.39, 69.15, and we're looking for an opportunity to sell short up above. Let's get the NQ. NQ is an inside day. The Globex range is 364. The daily ATR is 425. We could be looking for pretty close to bull trap and the bear trap as well. Okay. And that one's already been used. Here we go. Um, let's see. Team, could you take care of Kenneth's question about the start times and stuff like that for the pre-market routine? I think you already have, but all right, still an inside day. We're seeing price whipping back and forth. Breakout trades often fail on an inside day. And we can see that as we pull this back up here, 5-minute chart, you can see where traders could find a good opportunity to take that breakout, and now they're getting kind of whipped into shape here. Okay. Panic them out. Once you start seeing the patterns and you correlate them together, you start to see where all these little traps are at. Okay. Another important factor is watching where the 50-day moving average is on the NQ and the S&P. Yesterday, we were fully prepared in our community trading room to take a long trade opportunity. Okay. No, thanks, Kenneth. Yeah, we're still putting together. It'd probably be the following week after the pre-market routine course that I go through. It's going to be 2 sessions, about 3 hours, 90 minutes each session. And then the following week, we'll choose one of the days where we start really early, and I'll walk you through all the pieces that I go through. We'll just go right down the list. Check, 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 check. Okay. Something I do each morning as I'm preparing for in setting up the trade day. Sometimes a good observation of that um, is very helpful, okay, after you've taken the course. Okay. All right. So remember, breakout trades often fail. We do have a leg base right up in here. Zone entries only on an inside day. Dow's already filled the gap. Okay, that's one sign that we often see uh, on an inside day. I do like that little area right here. If we could get a pullback into that fair value gap. Okay. Russell's also filled the gap. Even though they're an outside day, there's a high probability that the gap will fill the same trading session. Okay. But it's a little less. It's actually more when we have not broken the prior session's high and low. So that's what we still are waiting for on the S&P and the NQ. Crude oil is approaching our potential trade opportunity, that bull trap area. You could even layer yourself into it by setting up some trades ahead of time, maybe at 65.99, taking one or two micros. And another one up at 66.10, which is where I have my other order. Okay. Nat gas. Okay. The manipulation phase is a little more tricky to trade. We've had a spectacular price movement up. And as you know, yeah, the 28th was the last trade date for gold and silver and some of the other products. Okay. Last trade date in meaning that people that are trading the gold futures, kind of like us, we're not looking to take delivery. Okay. So last trade date could be all of them exiting their position. Then the day after last trade date is where they start to buy back in. As we talked about the different commodities, okay, that have contract rollover and last trade date in a short period of time, okay? Most of the newer traders and traders like us that speculate, okay, we're rolling from the front month to the back month much earlier. But people that are holding or hedging, they're holding on to that insurance till the very last minute, okay? Then they'll cut the front month and look to buy the back month. Okay. Some of it happens right at and around the last trade date. Okay. Now, that doesn't mean that we're going into a bear market or a bull market. Okay. There's a lot of shenanigans going on with gold and silver and copper and platinum. Okay. And other metal products. Okay. So we have to anticipate that each time they're doing a contract rollover, that novice traders or newer traders are rolling from the front month to the back month, but more of the activity of price dropping is on the day last trade date, okay, or the right near that last trade date. And I'm talking about one session on the front or the back of that last trade date. Okay. Important that you go out to the CME group, understand on each of the commodities that you're trading, when is that last trade date? Okay. Look for prices to move lower into the last trade date and then after move back up. Okay. And that's what we're seeing on gold. Okay. So a lot of speculation, a lot of gaslighting and stuff like that comes in. But when you go back and study the last trade date, day before and day after, you'll see that there's a lot of commonalities each month on these commodities. Okay. Now, the last trade date does alter back and forth because of weekends and holidays and things like that. So it may seem pretty random, But once you just tie into that last trade date and contract rollover, you start seeing that the price patterns are very similar month over month. Okay? This is a very good price pattern here. Notice this, the structure where we have drop to base to rally, and we have the retest. Notice this high, sorry, this low is higher than this low. But also this drop to base is bigger than base to rally. So I want to look and see the Fibonacci measurement. Very often, if that Fibonacci measurement for a double bottom, I kind of look at the 88.6, okay? But when drop to base is greater than that base to rally, that 70.7, and some of these are the square roots of that Fibonacci number. Look at that, 70.7. Now, what's significant about the 70.7 is it has the longest running price moves, okay? Has the longest running price moves, okay? So I want to take a moment here, and since we're watching gold, how would you get into this now? Okay, knowing that it potentially has a very strong and big price movement back up to the 53.79. Where do we find a way into it? Okay, well, let's first start with the leg base. Okay, and I'm meaning to adjust the time frame up or down to find my entry and trade management. That's 6 minutes. Let's try 4. Okay. Now, this is the leg base group of candles. Inside of that leg base group of candles, we do have a fair value gap. Come on, pop up. There we go. So I have a range where I would look to participate in a long trade opportunity. Let's go back to the 5. See, all this information that we're taking from our pre-market routine is leading us to say, okay, well, how are you going to apply the trade now? There are many great traders out there that can call the markets, but the application of taking the trade and managing the risk is a whole different animal. Okay. Now we may have to wait. We're still looking for price projections back up to 5,400, which is another 300-point move back to the upside. Okay. Probably about halfway into the candle that dropped. Okay. But how would we get into it? Let's try a smaller time frame, like 2 minutes. And we're still waiting. 1 minute. Okay, now we're kind of faced with the reality. We're getting so close to having a potential trade, but now we need to wait. Okay. We know what the possibility is for price to do. And this is where, if we're looking for that price movement back to the upside, you have to have a very solid way that you're going to apply the trade. You had the 70.7. Well, that bus left. Okay. No longer there. Okay. You got to wait for the next bus. Now, the next bus may be up a couple of blocks, and we might have to wait for that to play out as well. Okay. But at this moment, we don't have an entry. How's our equity indexes doing? Breakout trade, failed. Yeah. And we had the breakout trade, broke out. Now you can get good at this because once you understand that the breakout trades often fail, that doesn't mean you don't have a trade opportunity. You just have to view and say, well, how many times does it fail? Does it fail very often? Okay. Does it fail 8 out of 10 times? 9 out of 10 times? How much does it fail? Okay. Because then you can start to rationale how you would participate in a trade if you knew it was going to fail versus knew it's going to work. Okay. How's the volume? Is the volume picking up? Wow. American Express down $10 and IBM down $8 and not even a million shares traded on it already. Is that normal? Is that light? Is that heavy? Okay. Dow. Okay. Yeah. Dow coming back down. Let's see. I'm dropping down to a 5-minute chart. Yep. There's the breakout trade. Now the Dow is already outside day, so breakout trades could be used. Okay. Sometimes when we start off these days, the um, the trade setups for application of the trade take a little bit longer to wait for. I'm really tempted to keep going long on natural gas. That's a very tricky spot. Gold. Okay, so we had the SPY, diamonds, Qs, Russell. No real big reaction there. FX market. Let's take a quick look over here. So on the dollar, we had a pretty big slide on the dollar, and that's a direct reflection on some of the things that we were talking about earlier as well. It kind of looks like we have a kind of a descending triangle there. Uh, it's been based in the last couple of days. We're also looking for when the markets are going to be more productive is when we see the dollar and the 10 and the 2-year yields correlated. When they're not correlated, they can have some uh, choppier market conditions. And we can see the dollar is moving up while the 10 and the 2-year yield are moving lower. The trend and the VIX are in neutral places, so there's no strong indication of where they are going yet either. Let's go out to our internals. Yeah, the trend's right in the middle. The VIX is backing off. Nobody's scared. But notice as the market opened, and as we're still about 20 minutes into the session, that there's been really no buy or sell programs kicking in. And that's a good indication that there's no urgency in the market, okay? And that also correlates with the inside day, okay? So we'll have to wait till the session gets more underway, okay? We do have a trade set up for the bull trap on the crude oil. We're waiting, okay? We're also looking at the S&P. We have a trade set up for the bull trap. We're looking for the gap fill. Gaps often fill the same trading day when we're an inside day. Okay. You might want to look and see if they're right towards the session close. Is there a smaller time frame? Is there a zone? We're kind of looking at how price based right there. And then in the Asian session, price dropped and dropped. So we had an expanding Asian session on the in Q. Okay. So if the Asian session was expanding, what are we expecting on? Well, the London session also expanded. So now we're kind of looking at the New York session could be a lot more choppy, sideways. Remember the AMD that we talked about, accumulation, manipulation, and distribution. We have one on who's speaking. Chevron has an earnings call. Trump signs executive orders. And this is all around 11 a.m. Eastern. Got a Fed speaker. European Central Bank. And what I'm making reference to is these things coming up here. This is Pacific time, so add 3 hours. Okay. Also moving lower. Okay, so let's change it back to 5 minute. Okay, so we got an Apple bouncing up. We got Broadcom bouncing down. NVIDIA. What are you noticing with these large market cap stocks? Are they all going the same direction, or they appear to be more mixed? Stocks move first, exchange traded fund moves second, and then the futures move. Futures are derivative. They follow the cash market. So when you got a lot of mix on the large market cap weighted stocks, what's really going on right here? That whipsaw, choppy market. Okay. All right. We have gold coming down. I do like that lower level. That'd be a second test of the 70.7. But I'm going to set gold up right now to go long above 55,088 and 80 cents. 80. So I'm looking for confirmation. If price can come down to that 5,040, 5,034, that would even be nicer. Okay. I don't suspect. Well, did I put the wrong price? Oh, the micro is moving faster. Okay, so we're long on the gold. Let's come back in, get our sell stop market in place. Wow, that's way more risk than I wanted to take. Well, we're trading the micro, right?
Order filled.
All right, go back up now. Don't want to watch this top me out.
Order filled.
Getting close.
Order filled.
Got it a little early on that one. Took the heat. Rally, come on. Get out of the red, get into the green. All right, we'll come back and look at that a little bit later. How we doing on the S&P? Still not there. NASDAQ, a lot of chop. We're already prepared for the chop. Russell hit that gap. Gap fill, sold right off. Our internals,
Order filled.
it looks like gold is going to continue to go just a little bit lower. Take every bit of that move.
Order filled.
Yeah, I got a lump to take care of. Right back at the 70.7.
Order filled.
Come on, charts, load up. Sorry, just waiting for my charts to catch up here. Funny how we talk to our charts, and sometimes they listen, sometimes they don't. But things are slowing down, that's why it's taking me so long to load up here. Looking to get back in on this. Just waiting for that turn. Let's look around, see what else we have here. Equity indexes have not really done much, not the S&P or the NQ. Good old inside day.
Order filled. Order filled.
Oh, we haven't checked Bitcoin out yet. Watch this. I'm gonna look for a fair value gap to re-enter on this. Okay, it's in the right percentage retracement, but I need a little more commitment if I'm gonna get back in to the long side. Indexes are starting to make that little push to the upside. We're still waiting for the S&P and the NQ to fill the gap. And of course, we're looking for the bull trap up above crude oil. waiting for the bull trap. S&P also waiting for that bull trap up above. Now, bull trap is not in line with a reversal. Okay, it's just an area where we would expect price to find some sellers and maybe drop down about a 1-to-1, maybe 2-to-1, not a reversal. Okay, usually a price is shooting up into that bull trap area. There's a lot of momentum behind it, so it's going to be a short-term pullback. And then if we do have a fair value gap in between, we could look to then splice into the move. Looks like we're starting to get that turn on the gold, but it's going to take a few minutes before we get a good fair value gap. Let's check the exchange traded funds. It looks like they're the gap down just to find the buyers, and now they're pushing back up. The S&P is getting close. Nice move on the S&P. But still, the inside day, look at the price action right here. We're seeing big candles, but we're seeing that very much that whipsaw. Not a lot of places to apply a trade entry. The reason I keep mentioning that is you only get to enter the trade when you have your entries there. Even though you see price move and you call the market, you call the move up. I knew I was going to do that, You had all the pieces in place, okay, but you had no way to apply the trade. I don't think gold is going to do it for us here. Let's go back to the gold. Might be looking for
Order filled.
come on, something set up. No fun when Friday's an inside day. You notice you had a resistance there, but you also had a support here. So this is what they would anticipate is that flip trade. The price flips direction. And we're coming in line. Again, I don't have a place to enter. I know I hear Chris in the background go, oh, you hit the button, hit the button. A little bit of headwinds coming right up here. We do have fair value gap in a place where we'd anticipate price to stall at about 5,084. S&P is approaching up. I think we filled the gap. Yep, just filled the gap on the S&P. Inside days, gaps fill often the same trading day. Good question, Ken. The fair value gap does not guarantee a trade, okay? But it gives you a place where price often changes direction, okay? And it also gives you a place where you can manage and choose whether you want to participate in that risk. The location of a fair value gap is also part of the process, okay? It's not just a space on the chart, okay? So it doesn't matter the time frame. The fair value gap is a place to apply a trade and also understand your risk. But all the information that led you to wanting to take the trade, whether it's price patterns or something else, okay, indicators, oscillators, okay, all the information that we gathered this morning, okay, is leading us to a direction that we would intend to trade, whether long or short, okay. But all that information we gathered did not get us to the application of taking the trade, okay. And this is where I've stumbled for many years, is that, you know, had great chart patterns, support resistance. You know, we see all these techniques, Fibonacci ratios and such, and we can validate things after they've already happened, or even anticipate a forward-looking move. You might have even made the comment, I knew it was going up, I knew it was going down. Okay. But that never gave you the opportunity. I mean, why didn't you just hit the button and get in? Okay. It's because there was something else missing, and that's how do I manage the risk? Okay. How do I calculate that risk ahead of time? Okay. How do we apply the trade, and then how do we manage the trade and our expectations after the fact? Okay. These are the big chunks that are left out in so many of the trading concepts that are out there in the marketplace. Okay. Is that it's a great concept. It's a great, beautiful looking trade opportunity, but they rarely go into the detail of how to actually apply the trade. And you might say, well, I just market order or a limit order and things like that. That's the mechanics of it. But what are you seeing on the price chart that's helping you make the trade? Okay. Is it a price pattern? Okay. Is it information on the chart where you're thinking bullish or bearish? Is there some fundamental information? Okay. So this would be an area, if I was bearish on gold, okay, and I'm not bearish on gold, I'm actually more bullish on gold. Okay, but this would be a place here, if I was bearish, we made lower highs, lower lows. I would expect some sellers here as price came back to that 50 or 5084. Okay. But it also gives me a place where I could manage my risk at that point. Okay. And say, okay, well, if I enter at 5084, my stop is at 5101 or the previous high. Do I want to apply that trade. And you might say, well, that applying that trade is outside my trade plan because the risk is too big. But if you don't logically have the conversations with yourself to put these pieces together in a chronological order, then you're going to be hitting the button, and then all of a sudden you realize that, oh man, that's too much risk. I'm going to blow my account. Or the greed monster comes in. I'm making so much money, you know. So sorry for the long answer, but you're spot on in asking the questions there. Okay. And right now we're at that phase where we're looking to apply a trade based off of a trading idea. Crude oil is a great one. Okay. We got a bull trap. Okay. I'm looking to take the trade short up here in the bull trap area based on information that I've gathered outside the price chart, information I've gathered on the price chart. Okay. Double top, Fibonacci measurements. But now as I got down into that area where I want to take the trade short, I look for a fair value gap. I look for the leg base, because that's where I will apply the trade in the trade concept. Okay. All right. How we doing on the S&P? We did fill the gap. Oh, yeah, I have some things I need to take care of today, and for those folks that attend Mastering the Charts recap and review, we'll be tacking that on next week, but today I'll be taking that off. Okay. So no Mastering the Charts recap and review today. Thank you, team.
Order filled.
Okay. So this became, if I'm bullish, that became a place where I was looking to take a profit if we're in an uptrend. If I'm in a downtrend, that would be a place I'm looking to take a short. Okay. Therefore, I could manage my risk. And also in observation, okay, there you're seeing that price came into that range and price is falling. That's not because of my one contract that I'm trading. Okay. Now, price falling to where? Okay. Now, as we find the demand area, the fair value gap, we're looking at this range down here being at 70.7. Okay. We see the drop to base was greater than base to rally. So if I'm looking to go long, I now have a place where I can apply the trade and a place where I can manage the risk. Now, once you understand what your trade plan allows you to do, okay, and this one by no stretch means that price is going down or means that price is going up. If you're bearish and you think gold is going lower, maybe you're using trend analysis, okay? And you're saying, oh, well, based on the trend on a 5-minute, I made a lower high and a lower low, so I'm in a downtrend. I'll look to sell short, okay? But where are you going to take your first profit? Where's the opposing zone? In my observation right now, I am looking at a structure, combination of patterns, okay? Let's take that little noise out. And I'm looking for this higher low compared to the prior low. And this is what I'm doing to build I'm just sharing my case as far as how I'm now going to work my way into applying the trade. Okay. I see the support and I see the resistance, meaning this whole area in this range has been pretty much used up. Okay. Price patterns that I've studied with the 70.7 often are in front of the biggest running price moves. Okay. So I've gathered the information of why I am bullish, why I am bearish. Okay. But this did not help me apply a trade yet. It just gave me a case. Now, if I'm going to follow the rules and per my trade plan, and I am remaining bullish, how do I apply? Okay. I know, hit the button. No, just hit the button. Okay. Have a plan. Because if I enter at 5,053 and my stop loss is at 5,000, I got to give this 50 or 47 point risk. Does that 47 point risk fall into my trade plan based on my personal trade plan? Well, it really doesn't. It's too big dollar wise. Now, technically, yeah, the picture's there. Okay, enter stop loss. Okay. But when you're trading a live account, trading your live account, and it's your money at risk, you assess it a little differently. I can't even trade one micro and stay within my risk parameters dollar wise. Okay. And we want to keep that in mind. Everybody has different risk parameters. Okay. And sometimes the trade is just outside your trade plan because it's the dollar risk is too much. So, yeah, I know that I had to do a quick recovery on my other account over here. Looks like gold is going to continue to move up. Now, this is the frustrating part about trading, and where traders get themselves in trouble, is not having a very clear way to execute on the trade. Okay. And then when they do approach their execution, oftentimes their risk is much greater than what they planned on. So this is where the fear comes in. You get into a trade and all of a sudden, oh my gosh, I'm risking $1,000. I was only willing to do maybe 200 or 300. And this is where traders have to learn more about themselves and establish what their maximum dollar risk is per trade. Okay. And then once you have that, that is one of the deciding factors of all your trades. If I enter here and stop here, am I prepared for that? Okay. Even trading one micro, this thing is going to be pretty tough on this time frame. Now I could change the time frame, and some people often do. They drop down to a 2-minute chart or a 3-minute chart, something smaller. Okay. Now and then they look to apply the trade because the risk parameters are a little different. Okay. But the approach is the same way. It's just applying, okay, is what cause you to stay or go. But once you start studying the fair value gap, you'll see that price often bounces off of these areas. But the bounce is not, well, if the bounce is not enough to satisfy the trade, you'll wait for it to stop you out, okay, or satisfy what your goal is, okay? So you have to, that psychology comes into play. I have some friends that you know they trade the S&P and they knock it out of the park dollar wise. But when you ask them to show you what they're doing, they're only taking 2 points on every trade. They're taking 5 contracts, 2 points. They go, oh, okay, I got a couple bucks. They never stay in a trade too long, and because they're only looking to get 2 points out of every trade. Now, that is not a style that I wanted to get into. But I can't deny what they're making. Okay, so let's just take a look at the cash. S&P is down 25 bucks. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 Dow stocks negative, 4 positive. So that'd be 6 negative times 2, be 12. So S&P futures are now oversold relative to the cash market. Okay. When the futures are oversold, we're looking for a demand zone to go long. It's like stretching the rubber band. Okay. Did gold bounce off of that? Yes, it did. But see, here's my frustration right now. I'm seeing this trade working and potentially could be green on the chart. But I avoided applying the entry because I didn't want to take the possibility of getting stopped out. This became my risk. Okay. Is all this making sense to you guys? I mean, these are the hard conversations that you have to have and understand your emotions behind why you waited, even though you called the trade exactly the right way. You have to get to the point where you can apply the trade and the application is within your personal risk parameters. Okay. All right. Enough preaching right there. I know I suck. I have to keep saying it to myself over and over again. That's the only way it sticks. All right, let's look outside of this. It's like the whole market is not giving us anything to jump in front of right now. Even the 10-year, the 5-year, 30-year equity indexes, all they've done is just gone up and down. So what is one thing that we've seen today that could impact this whipsaw price action or help you prepare for that whipsaw price action ahead of time? Inside day? All right, let's see what else we have. Okay, gap filled. We're still chopping around inside the prior day's trading range. Watch where the 50-day moving average is. If we look to close below it, we'll be below and possibly close the month of January below the open of January. And we come back and look, why didn't you just go short? You would have been making all this. Again, have that conversation. Where would you apply the entry? Does that risk fit within your trade plan? Sometimes this is the hardest conversation to have with traders when you're doing a live broadcast or live stream and you're seeing good price movement, but we're not seeing where we all could have made a nice, comfortable trade that fit with our risk parameters. That's why I take the time to try to explain it in a way that we can all relate to it, is that we don't have to jump in front of the truck. You know, as soon as you start hitting that button the wrong way, you get your emotions start to really come out. All right, let's see if we got something here. And I admire watching some of these traders take trades and um, based on the way they view the market. Okay. And there's no right way or wrong way to view it, but you need a way to apply it in order to get into a trade and a way to study what we've just been talking about. Okay. That's where the pre-market routine comes into play, having a systematic way to understand what's going on outside the marketplace, like what's going on with stocks. Because when you trade futures, you have to incorporate what makes a futures product go up or down. The Globex is a computer. It's an order matching computer. Okay. It matches the price of the index futures based on the stocks within that index and what the exchange traded fund is doing. So futures are what we call as a derivative. They follow the market. They never lead the market. Okay. But sometimes traders do think that futures they lead. Okay. When you watch closely, the stocks move first, exchange traded fund moves second, then the futures adjust. So it does give you some time to plan for your trade, utilizing things outside the price chart. Okay. Let's see. Now you may notice that like when I use a time-based chart to get the right picture. You just have to wait a little bit. Use a time-based chart, 15-minute or more so a 5-minute. And I use a tick chart. Now, a tick chart, I'm looking for the same price patterns, same way to enter a trade, manage my risk. The tick chart gives me a little different information because I can check the rhythm on a tick chart. Okay. If the bars are painting really fast, okay, then there's a lot of volume going on, a lot of trades, a lot of transactions. If they're painting really slow, it means there's few transactions. On a time-based chart, all we're seeing is price moving based off of the time frame that we choose. Okay. A pattern that is looking good right now is if we see what happened here, because I'm trying to make a case for taking a trade on the NQ. What happened on the Asian session? Okay. And now as the Asian session's closed, we're under the London session. What has the London session been doing? Okay. What would we expect out of this London session? You know, because we have a little overlap, okay, but the Asian, London, and New York session. This is where we see that the Asian session expanded while the London session consolidated. So when you look at a map, oh, geez, sorry, we're going over. All right, let me just finish this topic. Now, the better trades are going to come into play on an inside day between 10:30, 11 o'clock, and we're in that range, okay? So what we look for in combining the different sessions is we look for the sideways price action is what starts all of this, okay? This is what we refer to as accumulation. Okay. Now, with the accumulation phase, let's just get that, label that. Okay. After accumulation comes manipulation. Now, manipulation can be to the upside or can be to the downside. Okay, but the break is that manipulation phase. Now, some traders do great during the manipulation phase. They have small expectations, they just get quick little trades. Okay. But what follows after manipulation is the distribution, either to the upside or distribution to the downside. And these are the trading environment that I trade best in for my trading style. We have traders that, let me label that. Distribution, okay? So if price breaks to the upside first, we're going to look over to the left for it to match up with a leg base group of candles. Or you're going to wait for the opportunity to get a fair value gap to take it back down. If it breaks to the downside first, and usually it'll break to the downside or the upside about 2 to 1 to 3 to 1, the size of the range. So right now during the London session, the overlap, Asian London, and now part of the New York, okay, we're seeing that markets went sideways, okay? So if the price is going to get manipulated to the downside, then we would be looking for a much bigger move back up, okay? The inverse is if price manipulates to the upside, then we'll look for price to distribution to the downside. Now, one of the hard parts about doing live stream and teaching and trading in front of folks in the live market is we get stuck in this accumulation phase, which is kind of where we're at today. Part of understanding the accumulation phase is by looking at the large time frame, seeing the prior session's high, prior session's low, and where that Globex range is at. We're still an inside day. Okay. Inside days are choppy. They're not easy to trade. Okay. So I'm going to skip out of here. We didn't take a lot of trades. How did gold do? Is it still, yep. See it? It's working, but I couldn't take the trade because of the risk. Okay. So I wish everybody a good weekend. Have a super weekend. Get some rest. We start right back up with the live trading room on Monday. Tuesday, we have our community room. And get involved in learning things that I'm trying to display to you right now. Okay. Sign up for the, let me bring that right back up here. Get our pre-market routine course. Okay. I'll be covering a lot more details in this. It's in the evening, 7 p.m. to 8:30 p.m., 2 nights in a row. Okay. We will have the recordings and we do have a worksheet that goes along with it. So like a checklist. Okay. Have a great weekend, everybody, and trade safe.